Hello, everyone. Today we are going to walk through the essential building blocks of life insurance. Knowledge is power, especially when it comes to your financial future. Understanding these terms is not just about passing a test. It's the first step toward building a safety net for those you care about most. We will be asking and answering key questions today, but we won't stop at just the answers. I'll provide detailed explanations for each one. This thorough approach will help you truly grasp how the insurance industry works and how it applies to your real life. Let's dive into our first concept. First question: what term is used to describe the individual who is covered by the insurance? The answer is the insured. It sounds simple, but identifying the insured is critical because their specific characteristics dictate everything about the policy. The insured is the heart of the entire contract. Everything from the premium costs to the eventual payout is based on this person's specific life and history. When a company evaluates a policy, they look at the insured's age, health, and lifestyle. This process, called underwriting, determines the risk the insurer is taking. It is their life that is being protected, ensuring that their loved ones are cared for financially if the insured were to pass away. It's a personal and vital designation. Moving on to question 2. Which of the following is a risk? The answer is an individual may need medical attention after a risk. In insurance, risk isn't just a danger. It's the statistical possibility that an unfavorable event will occur, causing financial hardship. Think of risk as the uncertainty concerning the occurrence of a loss. It's the possibility that something unexpected might happen, like an illness or a sudden accident. When someone needs medical attention, that is the physical manifestation of a risk becoming a reality. The risk was the chance of injury, and the medical bill is the loss. Insurance is designed to mitigate the financial burden that comes with these unpredictable life events. It doesn't stop the risk, but it manages the financial fallout. Now let's talk about the math. The application of the law of large numbers enables insurers to. The answer: the law of large numbers enables actuaries to estimate future losses. Specifically, it helps them predict the losses of a class or group of people rather than predicting exactly what will happen to one specific person. This is the foundation of the entire insurance industry. It's a mathematical principle that states the more times an event is observed, the more predictable the average outcome becomes. By looking at millions of individuals, insurance companies can accurately predict how many total losses will occur in that group over a year with incredible precision. This predictability is what allows insurers to charge enough in premiums to cover all those expected losses while keeping the company solvent and reliable for everyone. Following that logic, the estimation of future losses is more accurate when the information is from. The answer is when information is from a large group. In statistics, sample size is everything. Small groups are volatile and unpredictable, but large groups follow stable, identifiable patterns. Think of it like flipping a coin. If you flip it twice, you might get heads both times. But if you flip it 1,000 times, you'll get very close to a 50-50 split every single time. Similarly, insurance companies need data from huge populations to ensure their calculations are stable. The larger the group, the lower the margin of error in their predictions. This statistical accuracy is what allows them to set fair premiums and stay financially sound. Without a large enough group, the insurance company would be gambling, not calculating. Next question: which type of policy is designed to protect against the risk of living too long? The answer: an annuity is designed to protect against living too long. While it sounds like a good problem to have, living a very long life requires a guaranteed source of income to ensure you don't exhaust your savings prematurely. While life insurance protects your family if you pass away too soon, an annuity does the opposite. It ensures you don't run out of money if you live a long, healthy life into retirement. It provides a steady stream of income for as long as you live. It's essentially a way to turn a lump sum of savings into a personal pension that you can never outlive. Annuities transfer the longevity risk. the risk of outliving your money, from you to the insurance company, providing peace of mind for your golden years. Let's look at how these companies are structured. Which of the following is a type of insurance company owned by shareholders? The answer, a stock insurance company. Insurance companies generally fall into two categories based on ownership: stock companies and mutual companies. We are focusing on stock companies here. Stock insurance companies are owned by investors who buy shares in the company. Their primary goal is to make a profit for those shareholders, just like any other publicly traded corporation. This structure often means they are very focused on efficiency and competitive pricing. The capital provided by shareholders gives the company a strong financial base to write policies. In a stock company, policyholders are customers, while the shareholders are the ones who own the equity and reap the rewards of the company's financial success through dividends. Here's a tricky one about location. The Zix Insurance Company is incorporated in Alabama but does business in Texas. This is, the answer, a foreign insurer. Don't let the word foreign confuse you. In this context, it has nothing to do with international borders. It's purely about state-level jurisdiction. In the insurance world, foreign simply means the company is doing business in a state other than the one where it was originally incorporated and received its charter. Since insurance is regulated state by state, a company must follow specific rules and get a certificate of authority to operate as a foreign insurer in a new state like Texas. This system ensures that every state can protect its own citizens by enforcing its own specific insurance laws, even when the company is based elsewhere in the country. Now, what if they are from further away? The Zix Insurance Company is incorporated in Mexico while doing business in Texas. It is, the answer, an alien insurer. This is where we move beyond U.S. borders. If the company's home base is in another country entirely, they are classified as alien. This is the term for companies incorporated outside the United States, whether they are from Mexico, Canada, or Europe. If they operate in the U.S., they are alien to our system. These companies must meet even stricter federal and state requirements to ensure they have the financial strength to pay out claims across international lines and jurisdictions. The classification helps regulators track the origin of the capital and ensure that foreign-owned companies are held to the same high standards as domestic and foreign U.S. insurers. Next, self-insurance is an example of which method of handling risk? The answer, an example of accepting a risk. Most people transfer risk to a company, but some choose to shoulder the burden themselves. This is known as risk retention or acceptance. When you self-insure, you aren't transferring the risk to a company. Instead, you are deciding to keep that risk yourself and set aside your own funds to cover potential losses. This is often done by large corporations that have enough capital and data to handle their own claims. They find it cheaper than paying traditional insurance premiums. However, it is a high-stakes strategy. It requires a lot of discipline and a very healthy reserve of liquid cash to be successful if a major loss actually occurs. Almost there. Which of the following is used to denote insurance companies? The answer, an insurer denotes an insurance company. In any insurance contract, there are two primary parties: the insured, whom we discussed earlier, and the insurer who provides the coverage. The insurer is the legal entity that provides the protection. They are the ones who take on the risk from the insured in exchange for the periodic premiums paid by the policyholder. When you sign a policy, you are entering into a legal agreement where the insurer promises to provide financial compensation for specific losses defined in the contract. They are your partner in financial safety. Their entire business model is built around the promise to pay when you need it most, acting as a financial stabilizer in times of crisis. Last one, a social device for spreading the chance of financial loss among a large number of people is the definition of. The answer, insurance. Insurance is at its heart a cooperative system. It's how we manage the unmanageable by sharing the burden with others. At its core, insurance is about community. It's a way for a large group of people to pool their resources so that no single individual has to suffer a catastrophic financial blow alone. By spreading the risk across many, the cost for each person remains predictable and manageable. It turns a potential disaster into a shared minor expense for the group. It's one of the most powerful social tools we have for creating stability, enabling investment, and providing peace of mind in an uncertain world. It protects dreams. I hope these thorough explanations have helped you better understand the fundamentals of life insurance. Knowledge truly is the best insurance policy of all. Thank you for walking through these important scenes with me today. Keep learning, and good luck out there.